So, what if I told you there's this global rulebook, one that was born from the absolute chaos of the 2008 financial crisis, and it's been quietly working behind the scenes to stop the next big meltdown? Well, today, that's exactly what we're going to unpack. The Basel regulations, the invisible shield that's designed to protect the entire global economy.
You know, it's the question that's probably on a lot of our minds. Could another 2008-style crisis really be lurking just around the corner? The answer to that, and honestly our collective peace of mind, it really all depends on this incredibly complex safety net that's been under construction for more than a decade now.
But before we get into the solution, let's just take a step back and revisit that moment when the whole world basically held its breath. The 2008 crisis, it wasn't just another market crash. It was a massive global wake-up call that showed us just how fragile our financial foundations really were.
Right, so in the aftermath, leaders from all over the world pretty much agreed on one thing. The old rulebook was totally obsolete. You see, banks had been playing this incredibly high-stakes game, but with way too little of their own skin in the game. They just didn't have enough of a safety cushion. A whole new global playbook was needed to stop those dominoes from ever falling in such a catastrophic way again. And that brings us to the solution, a global safety net, designed from the ground up to make the entire banking system way more resilient. So, what does this safety net actually look like?
Well, this safety net is known as the Basel framework, specifically the rules we call Basel III and the more recent updates which people have nicknamed Basel IV. The best way to think about it is like a global instruction manual for every major bank. And the goal? It's all about smarter regulation, much tougher supervision, and a totally new way of looking at risk management. And it all rests on three core pillars.
Okay, Pillar 1. This is all about the bank's own money, its capital. Now, this isn't the money you deposit. This is the bank's own funds that act as a financial shock absorber. The rules set a really strict minimum for how big that cushion has to be, making sure the bank can actually absorb unexpected losses without just collapsing.
Then you've got Pillar 2. This basically empowers the financial watchdogs, the regulators. In every country, they are now required to seriously scrutinize how banks are managing their risks, and if they spot a bank getting a little too reckless, they have the power to step in and force changes before disaster strikes. It's about being proactive, not reactive. And the final pillar is all about transparency. Banks are now forced to open up their books, to publicly disclose what their risks are and how much capital they have. The theory here is actually pretty simple. Sunshine is the best disinfectant, right? If investors and the public can see which banks are taking on wild risks, the market itself will help keep them in line. So we have these three pillars, but how do they actually work in the real world? Like, how do you actually put a number on a bank's safety? Well, it turns out it all comes down to one really foundational concept. And that core concept is called risk-weighted assets, or RWA for short. And honestly, it's a brilliantly simple idea. Not all of a bank's assets carry the same amount of risk. A mortgage given to someone with a perfect credit score is obviously way safer than a huge loan to some speculative tech startup. RWA gives every single asset a risk score, or a weight.
And here's a perfect example of how that works. A super safe government bond, that might get a risk weight of 0%. The bank barely needs to hold any capital cushion against it. But a much riskier loan to a big corporation, well, that could get a 100% weight, forcing the bank to hold a much, much larger safety cushion just in case that loan goes bad.
So this all comes together in a pretty straightforward three-step process. First, the bank has to assess the risk of every single asset it holds. Second, it adds up all those weighted values to get a total RWA score. And finally, that score dictates exactly how big the bank's capital cushion needs to be. Simple as that.
And this right here brings us to what is arguably the single most important number in all of modern banking regulation. It's called the Common Equity Tier 1 ratio, or CET1. This ratio compares a bank's highest quality capital, we're talking its core equity, against its total risk-weighted assets. It's the ultimate health check. So, what is the magic number? Well, under Basel III, the absolute bare minimum CET1 ratio a bank has to maintain is 4.5%. So what does that mean? It means for every $100 of risk-weighted assets a bank has on its books, it must have at least $4.50 of its very best, most loss-absorbing capital ready to go. That's the floor. It's the fundamental line in the sand for bank safety. But here's the thing. Making all of this happen isn't as simple as just plugging numbers into a spreadsheet. Nope.
Implementing these rules has actually sparked this quiet revolution in banking technology. For every major bank on the planet, this is a massive, incredibly complex IT project.
I mean, just think about it. To comply, banks have to pull and wrangle data from dozens of different systems, everything from the trading desks to the mortgage department. And that data? It has to be flawless. One little mistake can lead to billions in miscalculations and, you guessed it, huge fines. They are running these monster calculations every single day, and it all has to be automated to hit these super tight deadlines. It is a truly staggering data engineering challenge.
So after all of this, all these complex rules, these massive IT projects, all the headaches, what does it all actually achieve? Has it really made the world a more stable place? Well, the benefits are really threefold. First, and this is the most important one, it promotes stability by forcing banks to have that crucial safety cushion. Second, it creates a level playing field, which means banks everywhere are playing by the same core safety rules. And third, there's this really fascinating side effect. It's forcing the entire industry to modernize its technology, making them more efficient and data-driven in the process.
So here's the bottom line. What the Basel regulations have done is replace guesswork with data. We now have a powerful, globally understood metric to measure a bank's true safety and its resilience. It's not about what a CEO says in an interview, it's about what the numbers actually prove. Which, of course, brings us right back to where we started. Are these rules enough? Are they really enough to prevent the next crisis? While no system is ever going to be foolproof, the Basel framework is absolutely our best shot at building a financial system that supports the world economy without, gambling with its future. The real test, of course, will come when the next big storm finally arrives. Thanks for digging into this with me.